topic isn't really a topic. It's really everything that's left over. I've called it compliance. The first part, though, actually is tax compliance. This is the rules that we have for following the law and not following the law, going to jail, not going to, goes something like this. There are three things, three components here. You have tax planning or tax minimization. That is lawful. You can plan your affairs however you like. And it is perfectly legitimate to plan your affairs in such a way so as to reduce your tax liability. Okay, that is the Westminster principle that coming from that case from the 30s, about 100 years ago, and that is lawful. You can do this. Whether that's moral or not, that's a different set of rules or principles, but ultimately we're not concerned about that at this stage. We're actually going to talk about ethics and morality later on, but we're not going to worry about that there. That's lawful. So tax planning is lawful. Tax evasion, on the other side of the scale, is clearly not lawful. So that is where you have deliberately, unlawfully not followed the tax rules. So for example, you've got some income, you don't declare it. There are a bunch of things that you haven't actually had any outlays for, and you go to claim a tax deduction for it. That's just tax evasion. You're just cheating. And that's easy. That's straightforward. That's something that's obvious to go through and spot. What is not easy to spot is tax avoidance, because unlike in the criminal law, where you're either found guilty or not guilty, assuming that you contest something and it goes to trial. In tax, there's a sliding scale of things. And one of the things to note about tax and tax law is this idea of avoidance. That is where you have what looks like on the face of it followed the rules, but you've done it in a very strange, artificial or contrived way. And that's usually to, in inverted commas, to find or follow a loophole. That mechanism of tax avoidance can be unlawful. And we're going to talk about some of the mechanisms that the tax office use in order to try and bring actions against people, because ultimately tax avoidance schemes come up where Parliament has missed something. Tax office or Parliament has missed something, and people are having these contrived arrangements, but they're doing so purely with the intention to avoid tax obligations. Okay, so tax planning, lawful. Also note that where you get the choice to do things in legislation, that's always going to be lawful. So if you get the choice, for example, to use indexation for capital gains, assuming you've purchased an asset between 1985 and 1999, the choice between using indexation or discounting, that's the decision you get to make. Sure, you can do the calculations for both of those. One of them is probably going to be better than the other, and you can choose the one which is better for you. Completely fine. In fact, you guys, as you know, some fraction of you guys are going to go on and be financial planners or accountants or solicitors. Not choosing the correct option in those things to minimize your client's tax outlays probably going to send you down the path towards an action of professional negligence. Similarly, when you're using the depreciation values, this one's a little bit tricky because you're trying to guess what your income streams are going to be in the future. But ultimately, you get to choose. And the same with trading stock, the end of each period, picking how you want to value your stock. Also, the choice of vessel. So if you've got a business, you as the citizen can choose. Do I want to run this through a company, through a partnership, through a trust? You may have particular reasons in your life for doing each of those things. You may want to raise share capital, in which case company might be the way to go. You might want to have others, lower costs of entry and just have family members running it as a partnership. Maybe you want to have a low risk venture and you've got kids that you want to have to be the beneficiaries of that, in which case maybe a trust. That's fine. All of those things are fine. However, there's two sort of areas where this comes up. We've got what's called shams, then we've got the anti-avoidance rules. So a sham is where a taxpayer has made essentially a journal entry. Do you guys know what I mean by journal entry for you guys doing accounting? It's where you've just basically come to the end of the year and just said out loud or written it in your book saying, oh, I'm going to allocate $100,000 worth of income to my cousin Stacey. Yeah, journal entries, that's right. And but I'm not going to pay her anything. I'm just going to just say that I paid her and treat it to be as if that happened. Now, for the purposes of tax law, that sort of arrangement has no legal effect. So that the commissioner and the courts can look at a sham arrangement and just ignore it. So if you say that you're doing something, but you don't in any factual or legal way actually do anything to change the party's rights, that's a sham. It's an absolute sham as part of it. So these things come up, for example, in employment law, where, and you probably see what I'm hinting at, Stacey, working in HR these days, but where you have situations where you have employers purporting to say they are in fact independent contract when they're not. Has this come up at all, Stacey, in your time in HR?
Say it again.
Where you've got sham contracting, where you've got people who are employers, usually dodgy and small employers, trying to argue that the people that they have as employees are in fact independent contractors with ABNs and so on.
Oh, actually, I have come across, not in because I work for Hayes and they're like a massive company. So we have a lot of like regulations and stuff like that. But I have come across it like in terms of like when I was doing merchandising and stuff, there were some of them that required you to have like your own ABN and all that kind of stuff. And I don't know, it was like a whole thing where like you were only getting paid like a small amount, but then you had to do all this extra stuff as if you were your own business. It was, weird.
Yeah, it is. And that is because in Australia, having employees is really expensive. It's way more expensive. And it's far, far, far cheaper to just say, look, I'm going to pay you $200 and you just go and do this task and you just sort out your own tax. I'm not going to do any withholding. I'm not going to do this. I'm just going to pay you as if you were your own separate private entity. It comes up a lot. And what the courts have done, and usually this is the industrial courts, so you fair work in the federal courts, and they just, when something like that happens, they just look at the arrangement and say, this is a sham. We're just going to treat it as if you were an employee. And so all of those rules and benefits and things that they've missed out on, you're just going to have to owe that because this, trying to just argue that this particular thing had this particular arrangement was done in a certain way is just, it doesn't have any legal effect. That's a sham. And so that comes up in tax where you've had people that just say, oh yeah, I just inverted commas, just distributed this income to to these various people, but you didn't actually do anything. You didn't make any actual substantive transfers of money. You've just made a journal entry as part of that, and so that's a sham. It's a notional entry. The courts just read it down. They look through it. Now, other than shams, there are situations though where people become aware. Again, this can be through political pressure, or it can be through the tax office doing investigations. Sometimes it can actually come through the tax profession as well, where they've said that, hey, we've heard rumours that people are structuring things in certain way in order to reduce their tax, and they're doing it in very unusual ways. Sometimes this can come up also when the tax office and sometimes the public and the profession have thought the tax law worked in a certain way, and then the federal court has actually gone, no, we think it works different to that. That can happen from time to time. And sometimes you're just going to get pressure from political groups, action groups, say, "Oi, this is happening. People are cheating on the. It's not fair." And so, as such, they can create specific anti-avoidance rules to stop those particular things happening. Now, as well as that, though, there's also a general purpose set of anti-avoidance rules, which is this Part 4A, this thing down here. And look, you may have heard this or seen that if you've delved a little bit into the tax literature. It's relatively recent. It's only been around about 30 years. And look, it's a catch-all. It's the thing that the tax office use in situations where Parliament hasn't created a specific rule preventing this behaviour. So I'll look at each of those first. We've actually been through some of the specific anti-avoidance rules in the past. The Division 5 rules for non-commercial losses, for example, where you can't just set up a business and lose a whole bunch of money and offset it against your PAYE income. But you kind of can, but you've got to jump through a few hoops as part of that and really demonstrate that you've got an authentic business as part of it. The personal services income rules, that idea of people who create an entity, so corporation usually, or a trust or partnership, and derive personal services through that entity. So again, issuing an invoice through that particular entity, where really it's been done through the sweat of your own brow. But because things like companies, for example, have lower tax rates, that the particular entity would actually pay less tax if it's not passing the income through to you if you're on a high marginal tax rate. So that's why they have those anti-avoidance rules, to ensure that people don't do that. A couple of things to do with international tax that we'll talk about a little bit later, transfer pricing and ThinCap. The rules for minors. Yeah, if you're a minor, you can pass income streams through to your child, provided it's not more than $416 per annum. Then that's fine. Anything more than that, punitive rates start to come in. So every dollar beyond that, for the next $1,000, it's 66 cents to the dollar. And then anything beyond there, the whole lot is taxed at the top marginal rate. Last week, we talked about the deemed distribution rules, where you've got closely held sort of private companies loaning, purporting to loan money to shareholders. And that's really situations where we, with our own little private companies, could really easily manipulate that in order to have companies that we have and we control, and getting money back to ourselves in our own little pockets without needing to have or paying tax on that. So that's why they have those deeming rules, to stop people from doing that. So these are all specific rules that have been put in place to try and stop people from kind of cheating the system, so to speak, in a variety of different ways. Now, those are the specific rules, but the Part 4A rules, these are the general anti-avoidance rules, or the GARs. And the Part 4A, and looking at, again, because it's, we say it's Part 4A, you'll see it as IVA. So sometimes you see IVA, just appreciate that it's Roman numerals for the first bit. So it's the Roman number 4. And then there's a capital A after it because it's been added at a later stage. So it looks a little silly when you're looking at that. But that's really what it is. That's how you pronounce it. But there are 3 elements to it. You've got to have a scheme. There's got to be a tax benefit from that scheme. And the dominant purpose for the taxpayer entering the scheme must be to obtain that tax benefit. Okay, so there's 3 elements there. You've got the scheme, tax benefit, and the dominant purpose as part of that. So what's a scheme? All of these sorts of definitions that we've seen throughout tax law have a very broad, very, very, very broad definition. It's by design, it's supposed to be open-ended. It's not supposed to be something where you're going to go, oh, well, if this particular thing is a, is an option, or it's a this, that. And no, they've set this thing up. So any form of arrangement or agreement, proposal and such like, can fall under this definition of scheme. And note that the scheme doesn't actually need more than one person. You, as an individual, can take part of a scheme, even if it's just you doing things. Now, how do these things get found out by the ATO? Usually through auditing. That's when the ATO, they're pretty good at data matching. They've got a pretty hot data analysis team, and they've got access to a lot of data, and they use a lot of data matching. They use and they have a variety of tools for analytics. And I don't know if anybody here is doing any form of data analysis, but it would be an interesting career path. Okay, a couple of things that have come up. Again, it's relatively recent law. So what you find is that there's a lot of sort of journal and academic articles that have come out, not so much in the last 10 years, but in the sort of 5 to 10 years after the stuff came in and these cases came out. So Peabody and Hart are the two major cases where they've looked at this Part 4A. And to be honest, they've actually been pretty lenient on taxpayers in regards to this particular area. Because if you think about it, this general anti-avoidance rule, this is a weapon of the ATO. This is a weapon that they can use where people have organized their tax affairs in a certain way, which on the face of it is strictly speaking lawful. Sure, they've done it in an unusual sort of a way, but the tax office have, they in their executive function has smacked down on it. And so if you think about that, it seems a tad, sometimes a tad unkind, in that if Parliament didn't want this particular behaviour to happen, Parliament ought to create laws preventing it and stopping it. And sometimes that's what happens. Sometimes they try to use these things to argue there is a scheme, and particularly for things like multinationals, then Parliament intervenes at a later stage when they realise that this just isn't working. So generally, the courts are quite favourable. And one of the things they had, and it's talked about in the text as well, is the idea of there being a large scheme and small schemes that are a small part of it. So there may be a system which is set up in place, sometimes through a commercial arrangement. Lots of taxpayers are doing it, but this particular taxpayer is just doing one component of this. And what they've said is that, look, if you are just a small cog in the greater machine, that cog has to be capable of being analysed as a scheme on its own. All right, it has to be analysed independent from the other components as part of that, assuming that you've just got one taxpayer entering into that one narrow scheme. Okay, so schemes aren't usually it's quite straightforward to identify that a scheme exists, because it, on the face of it, will just look like an artificial arrangement, something people wouldn't ordinarily do. Now, the next element, though, is that it has to be not merely a benefit, it has to actually be a tax benefit. So there is a prescribed list of things. So, for example, the commissioner has to argue that if this particular thing if this particular scheme wasn't in place, that the taxpayer would, for example, have earned more income, or had fewer deductions, or had smaller capital losses, smaller capital gains, bigger capital gains or smaller capital losses, would have had smaller tax offsets, or would have had more money withheld if this particular system or scheme wasn't in place. So it has to fall into that category. If a taxpayer, for example, enters into what looks like a scheme, where they're doing investments in something where there's some option to buy this, that, and the other thing later, but it turns out that particular thing for a property scheme, for example, and it turns out that property just tripled in value, and the taxpayer makes something of a windfall gain as a result, that's not a tax benefit. That's a business benefit. And even if the thing was entered into for the dominant purpose of obtaining the tax benefit, the tax office can't cancel the benefits the taxpayer would have got other than these sorts of things. It's only this thing that the commissioner can go through and cancel. Because when they're determining this amount of benefit, which is the amount that they're going to be able to cancel, assuming that they win, they have to create this alternate hypothesis. What position would the taxpayer have been in if this particular scheme didn't provide this particular benefit? That's the alternate hypothesis component. Okay, so I think I might have mentioned this already. If you have a choice in legislation, so for example, you can choose to use indexing versus discount methods for capital gains. If the legislation expressly provides you with a choice, you can never fall foul of the general anti-avoidance rules, all right? Because Parliament's taken this into account. They can't argue that it's a scheme, an artificial contrived scheme. If you had a choice in the legislation, that's the choice principle. That is never going to be a, a scheme within the meanings of Part 4A. Now, similarly, if you have a situation where you could choose an entity type, so you've got a decision that you could make, and it can be more broad than that. A decision, for example, to trade in New South Wales as opposed to Queensland because they, you're a funeral director and they don't have state's duty or something like that. Or you're a polluting taxpayer and the Northern Territory has less stringent rules, for example. That's just a legitimate business choice. That's fine. And if you gain tax benefits from that, it doesn't fall under Part 4A, and neither does the choice of entity. If you have the option of having a partnership, a trust, or a company, or being a sole trader, that election and the fact that you will get tax benefits from one or the other does not offend Part 4A. You can choose when you run your business to have it in whatever structure you like. Okay, that's the choice principle. Okay, the third element is the dominant purpose. This may sound familiar. Stacey, remember you put your legal ethics hat on. We talk about the dominant purpose of entering into the scheme. Doesn't have to be the only purpose, right? You can have other reasons for doing making the particular action, but if the main one is to get the tax benefit, then you can fall under the Part 4A. And the courts they do a multi-factor approach. They look at all of these things. The form and substance is the main one. That's it there. And there's a variety of other things they'll look at. Look, this area will be a little bit complex in regards to doing this sort of analysis. There's a fair amount of cases. I'm not going to go into them now. Just note that the main factor they're going to look at, they're going to look at what's happened on the face of it, and then look at the underlying reality and seeing whether or not those two things just look a little bit dodgy, to be honest. Is it the sort of thing that business people would ordinarily do as part of that, taking into account consequences for the taxpayer and any of persons in and around or connected to them as well. So what happens if the commissioner thinks that you have entered into a scheme for the dominant purpose of obtaining a tax benefit? They can cancel that tax benefit. So they use that alternate hypothesis to work out what position you would have been in, but for this scheme, that is something they can do as part of that. Okay, and they can just go through and amend your tax returns. If they do go through to do that, that is a decision which has been made by the commissioner. What do we know about decisions of an administrative character made under an enactment? What are they subject to? It's the judicial review, not law. When the commissioner makes a decision under Part 4A, the first thing you must do is an objection. Okay, you have to do an objection. That's asking the decision maker to re-examine and remake the decision, assuming that they remake it exactly the same way. Then you can seek either to have the decision reviewed by the AAT, or you can go to the federal court. If you don't like the decision of the AAT, you can still go to the federal court as well. You've got to do it on matters of law only, though, from that point. Okay, other legislation. Look, the Part 4A is to do with income tax. It's solely to do with income tax. But to be honest, almost all of the taxing statutes have some kind of anti-avoidance rules in the general sense, and they, by and large, they read the same as Part 4A. That's hey, we give power to the various commissioners. So that's the the State Commissioner of Revenue and the Federal Commissioner of Taxation, who also administers these other things, the FBT Act and the GST Act and so on. We give power to the Commissioner to make these determinations. Because the benefits are slightly different, and these things have to be listed out. So the GST, for example, that talks about refunds, GST payable, altering the time of payments of GST or of refunds. So they have to map out what the particular tax benefits are in each of those statutes, but the actual operation is very, very similar. And that comes up in a variety of ways. And note that in situations where the tax system is being used, not the welfare system, to achieve certain goals. So this, cash flow, coronavirus stimulated passengers. You may or may not recall the Cyclone Yazi money. You may recall the global financial crisis money, or the Ruddy money we called it. If there are people that do set up systems, most of those sorts of statutes have anti-avoidance rules, general anti-avoidance rules put in there to give the commissioner the power to cancel those benefits in where people have contrived schemes to get that money. That's how that works. Okay. How are we feeling so far? It gets a lot worse, by the way. It gets so much worse. All right. So let's breathe. Multinationals. So multinationals, again, entities that operate across more than one just national jurisdiction. They are a special breed because they have much more power to manipulate their affairs in order to reduce their tax there, and they have a strong incentive to. So if you think about it, Australia is a high tax jurisdiction. Our top marginal rate is 47 cents functionally. So it would be trivially easy for companies to move profits offshore. Really, really easy. And so as a result, there are specific rules and there are general rules for trying to have, really trying to stop the multinationals from being able to leak their profits elsewhere. I mean, these things pop up every so often. Amazon paid no tax in Europe, for example. All right. Now, how do we manage these things? The starting point is using these double taxation agreements, which I have talked about earlier in the subject. Those are agreements between two nation states where they say how they're going to tax entities which operate between two jurisdictions. And the most common way they do that is through the permanent establishment rules. So it maps out in the treaty which country, if a country has a permanent establishment, sometimes they have it in both, in which case there's other rules for there. But if they have a permanent establishment in one and not the other, that is the tiebreaker, so to speak. All right. Here's the rules of permanent establishment. There we go. So permanent establishment is more than merely carrying on a business. It also applies where you have machinery, where you have construction projects, where you do selling, manufacturing, assembling, processing, packing, or distribution. Very wide definition of that. So if you have a genuine, authentic arm's length agent in another country, that's not going to be a permanent establishment, which I think I have in the next part. Yeah, that's right there. So if you've got a genuine, a bona fide commission agent, in other words, you're not running the show in Australia. So say you're a New Zealand company. If you set up a branch here, then you've got a permanent establishment, okay? And then we would the the New Zealand-Australia double tax agreement was set up in such a way that we would map out how and where the various amounts would go through and do that. If, however, don't have a branch here, you've just got a, but you're selling your products, but you're doing it through local suppliers, so to speak. In that situation, you might not fall under these particular general anti-avoidance rules as a result. It's this arm's length principle. All right. Note that, again, I think I've talked about it in this subject as well. If you are an entity with more than $1 billion worth of worldwide income, different rules apply. You've got particular reporting rules where you have to report, you must report on all of your operations globally. There are specific rules, and there are treaties Australia has entered into, where this analysis of all of these profits and the assets and the structures that are set up have a much larger compliance burden on these multinational entities. Okay, those are significant global entities, and there are particular rules for them. All right, there's a penalty tax regime. So if you're an SGE, so significant global entity, and you're operating in Australia, if you have a contrived or artificial system in place, then the commissioner can elect to just charge them a penalty tax as part of that. The commissioner just has the power to do that. And again, that is something where these things get litigated because SGEs have got big legal teams as well. But just make note, they really have their own rules, so to speak. And to be honest, the tax office has teams of people allocated to each of those entities. So, there'll be a team of people for Google, there'll be a team of people from Microsoft, team of people, and so on and so on, that are going and operating here because it's just worth it. It's worthwhile. If you look at something like Microsoft, they're making, clearly they have $1 billion worth of global revenue, but that they've got enough of that to warrant the ATO actually having people specifically liaising with Microsoft, talking to them about what they're doing, analyzing that, and determine what they're doing, and then looking at things to determine whether or not they are doing anything artificial or dodgy as part of that. Look, and it's different through that. It's a different system when because you think about it, it's actually an unusual situation where you've got this private entity, and then you've got government bodies. Okay, thanks, Maddie. Cheers. And it's, so you guys seem to, there's a lot, you guys, you got a lot of assessment on. I appreciate that. Just note, just for the purposes of there while you're there, that it's, we'll be doing another session next week. So note that this, if you have government agencies that are interacting with each other, that's quite different from where you've got one as a private entity and one's a public entity. So the tax office has teams of people that that liaise and interact with them as part of it. And of course, Microsoft, they have no desire at all to tell the ATO what they're actually doing, but they are obliged to comply with the significant global entity reporting rules as part of that. And so that's again, career-wise, I imagine those sorts of roles probably, as public sector roles go, are probably quite fun. Transfer pricing. There's only one slide on this. Steve actually told me off for putting this stuff in here. Why? Because it's outrageously complex. So if you do want to do this, it is in Tax 2. So it's in LA4023 and BX3112. One slide here where I'm obliged to tell you about what this thing is. Basically, a situation where if you have a vertical integration, if you, for example, are a company and you have a supplier in a low-cost jurisdiction, so we'll say Indonesia, you've got IND, or India, that's IND, can be both, and then you've got Australia. It would be trivially easy if this is the supplying company and this is the consuming company to just buy your supplier And then, say, I don't know, you're selling shoes, for example. You're selling the shoes for $20 each in Australia. All right, it would be trivially easy to set the price for the supplier to, I don't know, $19. What would be the effect of that? So if you, assuming that these companies are both owned by the same parent, the parent owns both of these. If you've got the Australian company and the Indonesian company, and these guys sell to these guys the shoes for $19, and these guys sell them for the public for 20, what's the effect of that? What's going to happen? Assuming that the shoes cost, we'll say, $3 to make in Indonesia, what's the impact of that going to be? Where's the profit going to lie? Assuming that you make and sell one shoe for the purposes of the example, but you can multiply it by 1,000 if you want to, or 1,000,000, what's going to happen? If your parent company owns two companies, one of them is buying products from the other one for $19, then selling it in Australia for $20, how much profit's the Australian company going to make? If you buy something for $19 and sell it for 20, it's going to make $1 profit. Yay. How much, assuming the thing costs $3 to make, how much is the Indonesian company going to make? Yeah, $16. So if the tax rate in Indonesia is 8%, the tax rate in Australia is 30%, you can see where these things, you can see where I'm going with this. Did the shoe actually cost $19? No, it didn't. But because the same parent company owns these two, they can set whatever prices they like as a result. That is a transfer pricing problem. And you could see probably like literally right now how you can run into some problems here. Why this requires a great deal of oversight, because it's trivially easy to do when you're dealing with multinational entities. Because the same company owns both, it can easily shift the profits from high tax jurisdictions, Australia, to low tax jurisdiction, India. Now, I actually don't know whether Indonesia is a low tax jurisdiction, but for example, if instead it was, I think Vietnam might be lower tax jurisdiction, but they're becoming fewer and fewer, but African nations maybe. But, you know, and that's the challenge that these things face. That's transfer pricing. And so the transfer pricing system looks at the arm's length value. So they would look at these shoes and say, what is the arm's length value of this particular thing? And look, it might not be $3, because $3 was the amount that what it would cost to make it, but it's probably, by looking at other similar Indonesian suppliers, you know, it's probably something like $5. And the amount of tax benefit this particular entity would have got, assuming that they, instead of having $1 worth of profit, they ought to be having $15 worth of profit. So instead, here at the moment, they paid 30 cents of tax, or would have been paying 30 cents of tax. They ought to be paying $5 worth of tax. As such, all right, if the tax office employs the transfer pricing rules, they're going to say, you now owe us $4.70. That's the amount of additional tax that you're going to have through the transfer pricing rules getting in. That's how transfer pricing works. Now, I haven't gone into how mechanically transfer pricing works, but that's ultimately that's on the face of it. It says these must instead be calculated. That's basically how that works. Because you can imagine that that's a difficult thing to police, but that's how the rule works. Does that make sense? It's one of those nice things about teaching accounting students that by and large this component, you're not quite as worried about numbers what the law students are. If I did this to my trust law class or stage 1 contract law, they get a bit they get a bit iffy about it, but that's how transfer pricing works anyway. Next thing, thin capitalization. It's kind of similar, but it's to do with leveraging. You guys know what I mean by leveraging? Well, we're going to start with this. What is this? What's that known as? Sometimes the E is a P, sometimes it's an E or a P, put in brackets P. What's that known as? Accounting students? Yay! Thanks, Claire. That is the accounting equation. Assets equals liabilities plus owner's equity. All right, that's good. Now, the process known as leveraging is when you get good at using other people's money. Say, for example, we go and set a company up right now, what are we, 5, 6 of us, and we'll put $100 in. It's not going to get that. No, all is right. I have to admit, Stacey, that is a particularly unfair question to ask. But there are one, was it two MBA and two BBus and BCom students. So that was perhaps the unkind one for you to go through an answer. But let's just say we're all put in some money into a company. All right, so let's say we've just done that right now. So we've got our company, we're set up, we're putting $1,000 each. So we would have our A would be $6,000, and our E would be how much? So we've created a company, put our share capital in, put $1,000 in. What's the E? What's that going to be? Assuming we've got no other transactions. So L is 0, the E is going to be 6,000. That's what it is. So that's the company we've set up. Great. We own, or our company, for example, everything that it owns is equal to everything it owes. That's the accounting equation. It is a tautology. Don't know if you guys have heard of the word tautology. Write that out there. Tautology.
You taught it to us the other week.
Oh, good. Good on it. Good. So it must have been the internals. Oh, great. So if we, with this company, we have $6,000 worth of, actually, if we go and borrow $3 million, what's the A equal to now? Okay, we'll say $3 million. So yeah, no, 3 million is fine. So A now equals what? 3 million. So 3,0,0,6,0,0,0. We now have. Is that right? Yeah, it is. That's the amount of money that the assets of this company now has. How much do we own? What's our equity in this entity which has borrowed $3 million? Does it change at all when you go and borrow a whole bunch of money? If you've got a company, set up a company, put $6,000 into it, that's a starting capital, then we go and borrow $3 million. Pretty dumb lender, but leaving that aside, assuming that we're the guarantors or whatever. What's our equity in this particular company at this stage? Shouldn't be this tricky. You guys are, yeah, Stacey has said can be forgiven, but if you put $6,000 into a company and then the company goes and borrows $1 million, does that change the amount of it that you own?
All right, I'm going to try since someone else is trying. Here we go.
Yay.
Does it like minus out like the amount that you put in then? So that's still what you own. You don't own.
You still only own $6,000.
Yeah.
And the company's got liabilities of $3 million. It owes to the bank or whoever they borrow the money from $3 million. Okay. All right. So that's means that this situation, that if you look at the amount of assets the company has, your $6,000 is now you own a company that has a lot of assets, but also has a lot of liabilities as part of that. It is highly leveraged at that stage. That's where we talk about leverage, that it has borrowed a lot, but not against the owner's equity. It's borrowed with independent third parties. So it's increased its liabilities to increase its assets, but the actual owner's equity hasn't changed. Now, let's just imagine that we have two companies. One, again, is in Australia, and the other is in Indonesia. Right, and they, again, are owned by the same parent. So the parent company owns both. It is trivially easy for this company to lend a whole bunch of money to this company. So say the Indonesian company lends $3 million. So we've got this situation here. We've got a company that lends $3 million to its Australian thing, still in the same parent group. All right, we'll say $30 million. All right, what happens when you borrow money? What are you obliged to do when you borrow money?
Pay it back.
Yeah, you got to pay the money back. How does that impact income tax, though? So if you remember, that's functionally a capital transfer. Does that have any real effect from our income perspective? No, there's no impact at all. The capital transfer, they're paying it back. It's perhaps a bit unkind or clear. When you check your mortgage statement, it's always one of those sort of sometimes depressing things when we look at our mortgages. You do repay principal as part of that over 25, 30 years, whatever it is. What's the other part you've got to repay? And you've got to pay every single year while there's a mortgage balance, interest. And what's the key thing to note about interest from an income tax perspective? If you have to pay interest on something you're using to derive income from, you get to do what in regards to that interest? I'll give you a hint, it reduces your taxable income. Yeah, you get to claim a tax deduction. So that it would be trivially easy for the parent company to issue a loan from a low tax jurisdiction to a high tax jurisdiction, then make the high tax jurisdiction repay interest at a high rate. Why? Why would you do that? You would do it in order to get the tax benefit. And so as such, and look, there are situations where you do have to borrow money, which is fine. And it basically means that through leveraging, borrowing and taking on excessive amounts of debt in Australia that is repaid overseas, that is called thin capitalization. Going back to our example before, where we've got our $6,000 that we've put in, but we've borrowed a huge amount of money. I'm going to get to puppy in a second. Oh, actually, everyone can see that. Everyone can zoom in on Stacey if you change the gallery mode. I won't put it in the recording though. That idea of thin capitalization, where you borrow an excessive amount, take on a large amount of debt solely for the purpose of getting tax deductions. So with that, particularly with that money, is then paid to other members of the same group. Okay, so that idea of borrowing money in Australia is an easy way to avoid paying tax in Australia, which is a high tax jurisdiction. And the thin capitalization rules, and again, they're quite complex. Again, we do it in tax 2, are set up to disallow certain amount of deductions for interest, where an Australian entity has a high debt to equity rate. Okay, so if you have an entity with too much, and look, obviously there are different rules depending on whether you're a bank and whether it's part of your business model and so on like that. But if you basically take on too much debt, where you've got entities that are in more than one jurisdiction, you will have to have, you can have some fraction of that disallowed. That's thin capitalization. It's one thing to just say, oh, a person owes a certain amount of money, but it's quite a different thing to actually get the money from their cold, clammy hands and get it back into the treasury. And so that happens in using a variety of systems. But it's important to note that people are kind of stupid. If you, for example, when I say you, I mean us, probably all of us actually. If certainly if you said to 19-year-old me for my first job, if I was just paid all of the amount that the contract entitled me to, and I had to sort out my own tax at the end of the year, I'd probably be in jail now, along with probably 80% of the population. We wouldn't save, the money would all go, and it would just be a disaster. It's one of the reasons, by the way, the superannuation scheme is such a great system. So, kudos to Hawke and Keating, is because of forced savings. Because most people aren't good with money. In fact, our entire capitalist system doesn't really work. If everybody was really good at saving, the whole system would fall over. You actually need to have some fraction of the population who are bad with money so that they are kind of obliged to keep working, which sounds a little bit awful, but ultimately that's how a system works. So the PAYG system is set up for a variety of tasks. It actually works more broadly than that. It's a one-stop shop. So money is withheld from things like salary and wages, and from bank interest, and from dividends through the imputation system, and amounts that are paid to non-residents. Okay, and for a variety of other mechanisms too. So when you pay people without ABNs and so on. Now, this idea of PAYG, what we call, which functionally is the withholding system. That's when payments are made on an ad hoc basis, where you just payments that are made to people who fall under one of these sort of categories. So that if you are getting paid salary, wages, allowances, bonus, commissions as an employee, money is withheld. That is PAYG withholding. But it also comes up in a variety of other places too, where the person making the payment is obliged to retain a certain fraction and send it to the commissioner. And the person who received the rest of it, the remainder of it, will receive a tax credit as part of that. Now, it's the same system, but it operates in a slightly different way with PAYG installments. So that if the commissioner gives you notice that you are to now pay in installments, that means that instead of doing your tax return at the end of the year and having money withheld, then paying an amount or getting a refund, that's why tax season's great in Australia, because a lot of ordinary human beings, we get tax refunds. It's great. But if the commissioner deems it, and they give you notice in writing, you become an installment payer, which means that you've got to pay an amount based on your last year's tax amount of tax that you paid, terminal amount. You've got to pay an amount quarterly. Sometimes it's monthly, but if you're large, if your annual installments are going to be over $20 million, you've got to pay them monthly. Now, the idea is that this really applies to businesses, because if you think about it, a business, you as a partnership, for example, you don't know what your net profit is until you reach the end of the year. And in terms of a risk management perspective, businesses, the tax office is gets worried, much as the tax office would get worried if we didn't have money withheld from our salary, that they'd go and spend it all. The tax office is worried that businesses, companies, trust partnerships, people won't put money aside. And so they make them pay your tax up front. In New Zealand, we call this provisional tax, which is always a really confusing thing because people thought it was a tax. It's not a tax. It's just a prepayment of tax that you're going to have to pay. And if you don't end up actually having tax to pay, then you get it back. That's how that works. Now, you can choose to pay annually, which really means you're not paying by installments, to be honest, only if you're quite small. So if you're not registered or required to be registered with GST, in other words, your amounts that your annual revenue is like 75,000 or smaller, okay, and you can't do it if you're in a group and if the amount of installment you've had has been less than $8,000, then in those situations you don't have to do the installment system. There's not really much to say about that. Look, if you guys do go into professional practice in accounting, you'll get to know this. You'll get to know this system really well. We go over this in a bit more depth in tax too as well. At the end of the year, you get tax credits, and look, you apply those last, of course. For example, you guys are aware sorry to Claire and the others, but for those living in regional centres in Australia, Townsville being one of them, Cairns being another, you get an offset just through living and residing in that place for more than half the year of $57. That is non-refundable, and so that offset gets applied first, and then all of the other offsets that aren't refundable, you apply those first against the tax you're going to have to pay, then you apply the refundable ones. Now, curiously, you actually don't have to do them. You could do it the other way around, but that would mean you'd be paying more tax. So you, again, go back to that, the choice principle. You're given a choice to do it that way. The rational choice is to pay less tax. Now, the PAYG, so the amount that your employer has withheld for most of us throughout the year, is refundable. If after we've applied all of the offsets and other tax credits, if we've still got amounts left over, that PAYG that we've already essentially functionally paid the ATO during the year just gets refunded to us. Okay, that should be pretty straightforward. Assessment. What's assessment? Assessment is the process of the commissioner determining the amount of tax you've got to pay. Because we've done and talked about taxable income and using the tax scales and doing all those things, but there it actually crystallizes at a certain point where you actually have the legal liability to pay. That's the assessment. And for most of us as individuals, we're partially self-assessed. We submit all our information, usually through the MyGov platform. We do a tax return, we submit it, but technically, the moment that it crystallizes in terms of us having either a liability to pay tax or getting a refund happens when the commissioner basically gets their stamp and they do the assessment of the information that we've supplied. Okay, that is not the same as companies. Companies have an extra year to do their tax returns, but they are full self-assessment taxpayers. They, when they do their assessment, must also, in theory, send a check or ask for the amount back from the tax office in regards to their returns, so that their assessment is complete when they submit it. Now, if you don't like what the assessment is, so if you are an individual, you've submitted your return, you get the thing back, and you don't like what the commissioner has said, or you're a company and the commissioner doesn't like what the company has said in regards to their self-assessment, all right, the commissioner can perform a reassessment, okay, and then they just issue an amended assessment as part of that. Now, you can object to that, and again, the objection follows the normal processes. So if there is an amendment, you can ask them to redo it. That's the objection, and then you can go through to the AAT or the federal court as part of that. Okay, that's the first thing to note. Second thing to note is default assessments. If you get a default assessment, it is really bad. I cannot stress that enough. I'm not going into any more depth here. Again, we talk about it much more depth in Tax 2. It's a bad, bad thing. If the commissioner is unsatisfied with the information supplied, or you do not supply a tax return, you will get a default assessment. The commissioner will tell you what amount of tax you have to pay, and you will not like it. And you will have a hard time challenging it. Because not doing your taxes and then complaining about the amount that you've been assessed on, as you could imagine, is not what we want people to be doing. And so that challenge default assessment is its own rigmarole, and it is arduous. All right, I'll leave you to ponder that one. The commissioner can change your assessment. Now, there are time limits to this. So, yeah, you probably need to know this. For small businesses and for individuals, the commissioner's only got 2 years to do it. So if they find information at a later stage and think there's been some form of, they've made a clerical error, for example, they've got 2 years to go through and to do that. For everything else, so trust, partnerships, this, that, and the other, is 4 years. And note that if there is some form of fraud, or tax evasion, then there is unfettered discretion to go back as far as they like. So that's just one thing to note, that it's only in situations usually where there's been some form of error, the commissioner can amend your return. Now, they can also ask you, by the way, and look, the ATOs, for a lot of the time, they're on your side. If an error is discovered, but it's to your benefit, you can actually ask for that 2-year amount to be extended. Now, the commissioner can also ask the federal court to do it, but they have to have particular reasons. Again, I think we talk about that in Tax 2. So that, just make note, you can do that. The commissioner has to go to the federal court to ask them to extend that amount. They're going to have a good reason for doing so. I think before I mentioned the objections and appeals process, we've talked about this a little bit earlier. Just note that the thing that I need to stress is that if you don't like a decision of the tax office, you must do an objection first. That is giving the relevant government agency the opportunity to remake the decision. Then, if you don't like how the decision's been remade, then you can go to either the AAT or off to the federal court. Tax rulings. Very briefly, look, oh, Risby, yeah, sure thing. Yeah, go Risby. Hope you're feeling a little bit better. Yeah, we're all going to be dropping like flies. By the end of it, it'll be, yeah, probably just be me and Stacey by the end of it. It's all good, team. You just go and look after yourself. Tax rulings. You can ask the commissioner to say, hey, look, if this set of facts comes up, all right, what's the law? So one of my colleagues, for example, was living overseas and then came back to Australia. And so as such, we went to seek a private ruling to determine what his residency status was. Because we're pretty sure he was going to be resident overseas, but wasn't 100% sure. And so as such, you can ask the commissioner to functionally make a determination of what they think the law is in regards to that, what they call a scheme. They should call it a schema in regards to that situation. And if that schema is factually correct, materially and factually correct, the tax office is bound by that ruling. They can also make public rulings that apply to all taxpayers, but note that public rulings can be withdrawn at some stage. So they can make a ruling and then go, oh, nope, sorry, we're wrong, and then redo it. But note that if there is a public ruling, you can ask for a private ruling on the same thing. Again, so it's just one thing, that note, if that does come up, there is public ruling, you can get a private ruling. All right. Yeah. So that's binding on the commissioner. Yeah, curiously, unless it turns out the commissioner was wrong and being wrong benefits the taxpayer. So a taxpayer can actually, it's win-win for the taxpayer in terms of rulings. But no, this is the sort of thing you might want to say for the exam when there's a letter of advice question, for example. If you're not sure, ask for a private ruling. That's what you as a tax practitioner will be expected to go through and do. All right, special taxpayers. Oh, okay. Oh, this is going to be fun. Oh, poor Stacey, poor Claire. All right, here we go. Look, we've talked about a little bit. I talked about R&D research stuff. Talked a little bit about small business exemptions. Not going to talk about authors, inventors, and performers. You just need to be aware they have particular tax concessions in terms of averaging. I will talk a little bit about PPPs though. So, and look, there are a variety of other ones as well. Mining companies, for example, they've got certain. These banks have got certain rules. Yeah, you just need to be aware of some of those. Wine producers have certain rules. There are certain industries that have certain special tax rules, kind of outside the scope of what we're going to do here. But because this is a university of the tropics, Steve has always had primary production in this subject. And that's what differentiates this course from other courses you'll have elsewhere in Australia. Small business concessions, there are stack tons of them. I'm not going to talk through each of these. It is something that in practice they will come up because for a lot of you guys that are working in accounting, if you're working particularly in smaller firms, you're going to have small business entities and they're going to have a variety of things. And look, some of these we've actually looked at throughout this thing. Car parking, CGT come up. Because the definition of small business, it's not all businesses are the same, and businesses of certain sizes, like up to 5 million revenue, then 5 to 10, then 10 to 20, and then less than 100. Each of these have different sorts of benefits as a result. Some of which apply to just the very, very small ones, and so on and so on. So I'm not going to go too much into these. We've occasionally dealt with them as we've gone through each of those topics. You just need to be aware if you're dealing with small entities that there are a variety of SPEs, and unfortunately they change every year as well. So you will have to, as a practitioner, you will have to keep up with that. It's the sort of thing that comes up as part of your continuous professional development requirements. PPBs. Pretty broad definition. It's pretty straightforward. It's a fact. It's a question of fact whether you're a primary production business. If you do things with plants, animals, fish, pearl diving, chopping trees down, milling, and processing trees. So just make note that you don't have to have all of your income, or even 50% of your income, in order to be deemed a primary production business. Okay, and there's no requirement that you have you actually earn a profit, but it has to be more than a hobby. Okay, to be a primary production business and get a bunch of the benefits that they have. So they get 4 types of benefits that we'll talk about here. Accelerated depreciation on a variety of asset types. They get to defer abnormal receipts. Thing is with farming, and the reason why we have this, Australia, I find it kind of funny. People think that farmers they have so much say in the political process. Oh, Barnaby Joyce and Bob Catter and so on. They get, they control this, that, the other thing. Really, they don't. I'm a Kiwi. I can tell you, as a fraction of the political process, farmers don't control your political process by no means, relative to what it's like across the Tasman. I can assure you of that. And so just note that these rules are there because Australia is a very difficult country to farm. It's I suppose technically the second driest continent. It is challenging. We have challenging ecosystem in this country. Was it 9 of the 10 most dangerous snakes, Arachangi crocodiles? It's a challenging place to be outside. I mean, given that where we are here, most of the time we spend inside in air conditioning. It's a tricky place to go through and do that. So we do appreciate that particularly small farming entities do suffer as a result. And so the tax system does take that into account. So they do get a variety of benefits. And yeah, we're going to go through these. I'll just make note that for the income averaging, it's quite tricky. I'm actually going to refer to Steve's slides. Well, I'll bring them up in a few minutes as part of that process. If I've saved them already, which I think I have. All right, let's go. I don't know whether I go too much into these. Yeah, there are certain types of deductions that they can get. So both accelerated depreciation and functionally changing the way deductions work, because you can get immediate write-offs for a variety of things. And there's certain things involving farm assets. So you have to be a PPB within that definition. And there's certain types of expenditure, phone, internet connection, land care, water facilities, fences. You get different depreciation rules for those things. 3-year write-off for fodder storage asset, which I think that's some sort of food and grain silos or hay barns and such like. Grapevines and new horticultural plantings, so that means table grapes, so as opposed to different ones for wine. So wine, not as good as, accelerated write-off. Okay, so it's actually longer for wine. Oh, there we go. And timber depletion. I'm not sure how that works. In fact, I'm not even really sure what that is. Anybody? You guys know much about any of these things? Timber depletion, which I presume is your forest getting chopped down. I'm not sure. I genuinely don't know. Just know that such things exist. All right. Okay, so one of the things to note that occasionally you're going to have to share your sheep. I don't. It's always funny as a Kiwi, you lot with your stupid sheep jokes. Oh my God. I got a sheep joke from the judge, literally Judge North, when I was getting admitted as a solicitor. So that comes up from time to time. And yeah, it's probably not an appropriate time for me to get into some responses to those. But nonetheless, sharing your sheep. In situations, there's a sheep. Oh, good work, sheep emoji. Thanks, Stacey. Cheers. Usually you will, your sheep will grow their things. So here's your year. They get shared at a certain point in time, and then they grow their wool again, and then you share it off at some stage later on, and then they grow back. So that's supposed to be a year, and usually it would be about the same time every year. When do they do the sharing of sheep? Is it the end of things? That'd be springtime, so it's probably like, I don't know, August. So August there and August there. However, if a fire, drought, or flood means that you've got to get your sheep and you've got to clip them a little bit earlier, it would be a little bit annoying if you've had, rather than doing this in August, you've had to go and do it in June. Why? Because that would be before the tax year. And so what they just say is that, look, if you've had to do two wool, what they call it a wool clip, I can't pronounce it, you can put it off. So instead of you have to do it in June, you can just say that it's in the next tax year. There we go. That's that rule. If you get an insurance payout, remember what's the rule for insurance payments in terms of what the character of those things are? If you remember that Meeks's case. I'll just tell you, it was a while ago. Meeks's case says that, look, an insurance payout or a compensation payout, it takes the character of what it replaced. So if you're getting stock replaced, it's going to take the form of income functionally. Hey, you've had these things, they've been disposed of, and you've had them replaced. You had some payout for that. All right, so that you get a loss of it, so that's going to be a deduction, and then you would get the amount recast, which is going to be income. So if you lose your livestock, or you get you lose your trees and you get an insurance payout, what they say is that, look, the trouble with that is that you are going to have the loss and ask the insurance company, but their money might not come in the wrong period. And unfortunately, going back to this example here, it could end up being in a tax year where you're going to earn a whole bunch of money as well. And that would be really, really annoying. And so what they say is that, look, if you do get a payout for those things, you can spread out over 5 years. So 20% in the current year and 20% in each of the next 4 years. So that's how you apply that income. Okay, right. Fun part. Stock concessions. All right. If you get a again, if your stock die, or they have to be disposed, oh, it's awful when I say that, disposed of, because the government has said you need to get rid of the stock, or they're going to acquire your land, or the past is destroyed and such like, and your stock die, and you again get a payout of that. So, or you go and you buy stock and then to replenish that amount, the relevant profit associated with that you can actually spread out over 5 years, because again, it's going to happen at an unusual time, because you're not going to make profit in the same year because the stock's gone. It's going to be an extra year, so that you may end up making, having an additional amount of profit at a subsequent stage. So what they say is that, look, when that happens, again, you can spread that out over 5 years, 20% per year. Okay. Income averaging. Income averaging is tricky. So because if you think about it, if you and I, let's just say we've got a job, and our job, sure, we might go up in salary, but assuming we're saying this, assuming that we stay as casual academics at JCU for more than 5 years, sadly, and assuming that you're earning a similar wage, same way through, you paid the same, let's just say I earn $60,000 per annum, right? If it's me, I'm going to earn a similar amount every year. Why? Because I'm doing the same task day in, day out. And assuming that's the case, leaving inflation and wage creep and so on. All right, that's what an ordinary human would have to pay, which means that you're paying, what's that, about $19,000 tax every year. All right, that makes sense? You're with me so far? Yep, okay, sweet. However, let's just say you're a farmer over the same period of time, and you, I don't know, sell mangoes. One of my colleagues here, she owns a mango farm. And so this year it's 60,000. Sweet. But the next year is a bumper year. The price of mangoes doubled, 120,000. Yay. And then the year after that, your mangoes all die and you earn nothing. Then the next year, yeah, we've got a slightly smaller year, it's 30K. And then the year after that, oh yeah, we've had, again, a pretty good year. We did some planting and replanting, and then we've reaped the benefits of that. Now, functionally, you've earned the same amount as me over the same period of time, but because in some of these periods, like this year here, you're in higher marginal rates, in aggregate, over this period of time, whatever it is, assuming that's 19 times 5, which is 95, I pay $95,000 tax. So me, as the PAYE person, just with a job, pays $95,000. But because of these two marginal things, this person's going to have to pay more. You have to pay sort of $120,000 tax over that period. And that's not particularly fair. And so as a result, we have this averaging system where you can go back over the last 5 years, all right, so up to the last 5 years of, and work out, it's not actually the income you're paying, it's actually what they call a basic taxable income. Okay, that's the amount that you use when you're trying to work out what is the average amount of tax that I have paid in the previous how many years. What we're going to do is say that, look, that's going to be the the tax rate that we're going to apply to the current year. Okay, so it takes a little bit to get your head around, because going back and looking at this farming example here, really what we're trying to do is to make these two figures, this 95K and 120K, the same. That's really what we're trying to do. We're not trying to really give them a tax concession as such. What we're saying, though, is that, look, if it wasn't for these ups and downs of the farming profession, your tax rate would have been constant. So me earning $60,000 every 5 years, my tax rate, effective rate, is the same. Whatever it is, 30. No, it's not even 19. Probably should have booked in a nicer number, but assuming it's just under 30%, so it's 28%. Is it? I want to calculate that now. 19 divided by 60. Ugh, it's annoying. It's 31 2/3. But we'll say that we'll approximate and say that it's 30%. All right. I should have picked a better number. Sorry about that. 18. I should have said 18. That's what I did. I just changed it to 18. There we go. That's 30%. 18. Just pretend this was 18 and this is 90. All right. And this person's paid, we'll say 120. Doesn't really matter. What we want, though, is to go back over the previous periods. All right. Work out what the average taxable income, we call it the BTI, though, because it's not actually the same as their actual income, because we're going to remove some things from it. We call it their basic taxable income, and then we're going to work out what the average is over 5 years. All right, and that amount is, then we look at the marginal tax rate on what that basic taxable amount would be. That is the tax rate we're going to apply into the current year. And if we apply that tax rate to the current year, and would mean that we would be relative to this BTI, this average rate, in the current year, we would be paying more tax normally, like in the current year, then we'll get an offset equal to the amount. If the BTI is actually less, and we've had a bad income year, we're actually going to end up paying more. So we have to it actually adds to your tax payable. So averaging is the system where it goes back over the last 5 years, or less than that if your primary production business started in that time, works out what the average income is. There's basic taxable income, the average income over that period. Then we look at that basic taxable income, the average, and we work out what the actual tax rate would be. All right, over those periods, that particular period of time, and we use that tax rate in our current period on our actual income. So to find each of these, so I'll talk about these because this, and then I'll use the example. I'm actually going to use it from Steve's slides, I think. All right, so a couple of things to note. This basic taxable income, so the amount that we use for averaging, doesn't have capital gains in it. All right, and a bunch of other things, CTPs and other things. We're not really concerned about that. But that's just the key thing to note. So if you've made capital gains, you ignore that for the purposes of that. I mean, if you happen to have a real corner case where you've got a farmer who's also an author, inventor, performing artist, production assistant, or spokesperson, good luck. But the key one here is this. So when you're doing an averaging problem and you're trying to work out what the person's income is from each of those previous 5 years, you have to ignore capital gains there, ETPs and other bits and pieces. That's the basic taxable income. Now, most people who run farms are also going to have a little bit of income from other things. And the main one here is things like dividends and bank interest. And what they say is that, look, if it's a small amount, just add it. Just put it in. If it's less than $5,000. If it's more than $10,000, you just exclude it. You don't include that. And if it's between those two things, you put some fraction of it. So it's $10,000 less this non-primary production income as part of that. Yeah, that's what they call it, the shade out amount. You are automatically enrolled in this if you are a primary production business. So the tax office, and again, once you put it in MyGov, it's automatically do your return. It's automatically going to do averaging for you. You can opt out. Once you have opt out, you can't opt back in again. This is one thing to note there. All right, last thing we'll look at, farm management deposits. And farm management deposits is an interesting thing. The idea is that, look, some years farmers are going to have good years, and other years they're going to have not quite so good years. So to give them a little bit of flexibility, it's actually kind of cool. They can take an amount of money, put it in the bank, and get a tax deduction for doing so. So if they have a good year, and they get a bunch of cash, in that year, they can take that money, put it in the bank, get a tax deduction. And when the money is taken out again, it counts as income. Well, the idea being that, look, if you have a bumper year, you're going to make, you have a high taxable income. Why don't you, again, to smooth these things out, you can put the money in the bank, and then when you need it at a later stage, when you're not having a good year, take it out again. Because in the years when you're not doing very well, you're probably not going to be paying much tax that year. So that can count as income at a later period of time. It's kind of cool, actually. And here, just make note that your non-primary production income has to be less than that. Each deposit's got to be $1,000 or more. The total amount at any given time can't be $800,000. It's got to be done with an actual bank, and you can't have anything weird on. You can't have some option or subjects or other bits, anything tricky in regards to those transactions. Just have to note those ones there. You also can't withdraw them within 12 months. It's got to be at least a year that's sit in the bank. And farm management deposits can't exceed your primary production income. So if you've got a little bit of non-primary production income, you can't go and use this to offset more money than you actually made from your primary production. So what's ethics all about? Ethics is a discipline and a field. So you can be, okay, I guess you can be a professional ethicist. I know some, but it's a discipline. It's like you'd have other disciplines, sociology or chemistry or what have you. The field of human endeavor. And the idea is that unlike just clutching at systems of morality from religious texts and such like, ethics is about deriving ways of doing things right from first principles. So that's really what that's about. It's really starting with the building blocks of philosophy, which curiously, if anybody goes to Wikipedia and you click on the first link, keep clicking, no matter what web page in Wikipedia you start with, you will always end up in philosophy. There you go. Fun fact. Try it one day. First link on every page you go to. Click, end up in philosophy. Now, ethics is different and distinct from morality. That's different. It's a different thing. So morals is not the same as ethics. They're just not. Ethics is stuff that we have deliberately mapped out and structured over a long period of time. And there are lots of theories, and there is no one true theory of ethics, but there are certainly better arguments and worse arguments. And I'll explain what I mean when we go through some of them. Now, for the purposes of what we're doing here, there's really three sort of big branches of ethics in terms of the model. You have the study of meta-ethics, which is trying to determine what an ethical claim is. Then you've got assuming that we accept what those that there are moral claims, what are eventually the frameworks we should use for mapping those things out? How do we categorize ethical claims into groups? What are the big categories? That's normative ethics. And then once you've done that, how do we put that into practice? That's applied ethics. We actually take those things and plop them into real world scenarios to work things out. Now, from our perspective, in terms of what we're doing here in terms of tax, we'll note that I guess a subcategory of applied ethics is professional ethics, the things that applies to certain professions. And you've got business ethics, legal ethics, tax professional ethics. You would have other ones too, medical ethics and so on. But this is a system of taking things from first principle and creating and constructing frameworks from that you apply in particular scenarios. So functionally, that's what ethics is all about. This, by the way, there is actually a section on this in the textbook. It's just rubbish. That's all. So we had to go over it again. So I'm not concerned about meta ethics. No, not worried about that. You go do a course on philosophy if you want to get that. Here, the second part though, we're gonna talk about the frameworks, all right? Because there are three branches, unlike two, which the book talks about. Good book. You've got three. You've got when we're trying to work out what a particular whether a particular action is ethical or not, you can look at the act and you can look at things that are somehow intrinsic inside the act, or you can look at things that are extrinsic and outside the act itself. Those are the first two ways that you can look at that. You can also, rather than look at the act, you can look at the actor. That's virtue theory. That's the third branch of normative ethics. And so loosely, we refer to things, the extrinsic stuff, we refer to those as teleological theories, so things that where we're determining whether something is ethical or not. Those theories say that, look, you need to look at something outside the act itself. Deontological theories look at something which is intrinsic to the act. So it's something that's inherent in the act itself that is right or wrong. Whereas virtue theories look to the actor. They look at the traits and characteristics of the actor to determine whether, in a particular situation, whether something is ethical or not. We care about the actor in virtue theory. So the first one, teleological theories. Look, there are a bunch of these. One of them is very important. The others are not. The important one from our perspective is what's called utilitarianism. That is the idea, which I'll talk about in the next slide, about the greatest good for the greatest number. There are some others. They are not very good. And, well, perhaps that's unkind. They aren't as internally consistent with themselves. And again, I'll talk about that, egoism, hedonism. Just note that there are religious frameworks that kind of are teleological in terms of how they do, but they're not really ethics derived from first principles and essentially in the same way. And they're a little bit, you'll find that the religious frameworks sit in all three categories, which usually isn't a good thing, because functionally you can just grab anything from the big religious texts to kind of justify any particular position, which, given that the purpose of ethics and mapping this out and structuring it is to put language onto frameworks to make it clear and delineate and understand what ethical behavior is and ethical acts are. And so being able to pick and choose things from everywhere is actually very I wouldn't say unscientific, but it's an unhelpful way of going about doing them. So that's why in terms of religious frameworks, they're not really that helpful in terms of the discipline of ethics anyway. So the reason why we have to look at utilitarianism is that this functionally, this cost-benefit analysis forms the basis of social policy a whole bunch of ways or in many situations. Why? Because we have a finite number of tax dollars in order to go and make decisions on the macro scale. Now, utilitarianism, though, more broadly, is all about consequences. So we have teleological theories, and a subset of those, the thing extrinsic to the act is the consequences of an act. So we're determining whether something's ethical, based on what the result is always likely to be, because most of us can't read the future. And utilitarianism says that, look, an ethical action is one which maximizes the best state of affairs. Okay, it's to bring about the greatest good for the greatest number. Now, you can see that there's some problems with that. Who are we talking about? What do we mean by concepts of the good? Do we all have the same concept of good? Well, we don't. And we conflate some of these things with dollars sometimes as well. And the key things to note here, though, is that there's no mention of the self. Utilitarianism is absolutely, completely, agnostic to the actor as part of that, who the particular people are who are receiving the benefits. Utilitarian theory just doesn't care. That's not a core part of it. We're trying to maximize the best state of affairs. Who that gets maximized to isn't relevant. Okay, that's a really important thing. So if you're maximizing, happiness just for your family at the cost of every other taxpayer losing $19, that's not utilitarian. And it wouldn't be ethical under those things. And look, there's two ways to go about undertaking utilitarian analysis. One is what's called act utilitarianism. That is where every time you do a particular thing, you have to go through and do those calculations. What's going to lead to the best state of affairs? And think about it every single time. That's really hard. It's a hard thing to do because we are human beings bounded by rationality. Okay, we don't have the time to figure out all of these things and to work out what's going to happen in most situations to the end. So that this alternative way to do it is what's called rule utilitarianism. That says that, look, we're going to create rules ahead of time, and the reason we have these rules is that in aggregate, in total, it's going to maximize likely future utility. Probably a bit rough for Stacey and Claire to be thinking of rules like that now, but one example of this is drug policy and drug laws. So we create rules in our society, criminal rules that criminalize the use of drugs. Why do we do that? It's because policymakers hold that the aggregate over the long term is better for everyone if people aren't using drugs. And they're probably right from that perspective. Now, the idea is that people don't have to think, which sounds awful, but you're not having to make a calculation when you're determining whether or not you should go at or above the speed limit. Why? Because we put a rule in place that says the speed limit is 100. Why do we do this? Because we, as a society, through our enshrining things and validly passed laws of Parliament, have decided that that number is the point where the trade-off between people getting from one place to another and idiots driving too fast and so on is just the right spot. It's the sweet spot. So we've put this rule in place, not because we think it's this great universal principle of justice or anything like that. We just think that in aggregate balances out those interests to lead to the best results. That's what rule utilitarianism is all about. And sometimes you need to revise that. Sometimes speed limits are too high, occasionally too low, and you do need to go and change those things. That's what that's about. All right, so that's utilitarianism. Egoism is, if you read the economics literature, they talk about the individual self as a rational actor maximizing their own utility. That we're all self-interested beings that want to do things to get ourselves ahead. That's egoism. So it's basically utilitarianism, but only for you. Okay? Now, it's not a very strong theory. Why? Well, a couple of reasons. First of all, existence is social, and it denies the aggregate. If I get a little bit of joy from watching all of you suffer a lot, under egoism, that your suffering wouldn't be relevant. It would just be my benefit, which is kind of, again, no, we don't think of that intuitively as being very ethical. It's not. It's quite internally inconsistent as well. There's also a subset of this called hedonism, which is the idea that equates your individual pleasure as the thing to be maximized, your joy, your pleasure. And again, it's not a particularly strong framework, to be honest. But anyway, but that's the way that they analyze things in some branches of economics. We're trying to maximize utility for the individual as opposed to for the collective, which is utilitarianism. All right, so the second branch of normative ethics is not concerned about things outside the act. They're concerned about the qualities of the act itself, doing something or not doing something because there is some duty that's imposed somewhere. Okay, and that idea is that there are rules. And these are universal rules. These rules are put in place, and the rules are there, and these rules exist not to do anything to do with the consequences of those rules being followed. Okay, there is some other reason intrinsic to the doing of things or refraining from doing things that does not care about the consequences or things to do with the person doing the particular action. And again, there are some religious frameworks where we look at that. Also, we're not going to look at. But again, if you're plucking things from these big religious texts, you can sort of make whatever framework you like. But again, it doesn't really help when you're trying to analyze it. The two we are going to look at is the theory of a guy called Immanuel Kant, a very, very, very clever human being, and also human rights. Because if we think about it, human rights don't care about consequences either. So we'll talk about these in turn. So Kant's theory is to do with the universalization of moral claims. So basically, he starts with the premise that we as human beings are moral actors, and we recognize other human beings as moral actors. We are more than merely meat machines. We, in our very nature and essence, have morality, and as such, ethical actions must follow things that takes into account the sanctity, so to speak, of all other rational beings, all other agents as part of it, because part of being human is to exist. And again, Rene Descartes did a similar thing. I think, therefore I am. Is that it's the very nature of this. You can't treat other rational beings logically any different than yourself and how you treat yourself. You can't. That's part and parcel of it. So you can't treat other human beings as means to an end. They are, they're ends unto themselves, so to speak. And in order for things to be ethical, a particular ethical claim, doing something in the world, must be able to be universally followed. Okay, so that, that's right, without any inconsistency. That's Kant's theory of, what do they call it, of, I can't remember what the text was. I've got it there, no, I haven't got it there. Rationality, really? No, what's the word? Morality, yeah. So that's what Kant's ethical theory. It's known as the categorical imperative. Everything has to be able to be done as a universal rule, so to speak. If I, let's, is it okay for me to inflict pain on other people? Well, is it okay for everybody to inflict pain on other people by stabbing them or whatever? That's something that can be universalized. Don't stab people. And it also aligns with the second part, which is treating other rational beings as ends unto themselves. There's an aspect of sacredness, so to speak, of human beings because they are rational actors and capable of reason. Okay, and note that that's different from the golden rule, which is the Christianity and so on like that, which is a little bit, it seems like it's the same. Oh, do unto others as that have done to you, but it's actually slightly different. It's a bit more sophisticated than that. You know, do unto others as they would do to you. So, yeah, so what grade do you want, Stacey? What grade are you going to give me? Well, only one of us is giving grades, so it's it doesn't really work. It really doesn't work. Because oh well, if you're in my position, well, I'm not in your position. That's the challenge. Well, that's why the golden rule doesn't work very well. Anyway, so that's a nice piece of philosophical fluff. There you go. You know, you've learned about Immanuel Kant. But something that does come up from a legal perspective is human rights. This has been very much a theme of law, and these days, in fact, the last 2 years of legal practice in Queensland. The idea is that rights are things that we enjoy that give us some benefits. Human rights are benefits that somebody has and does not impose any duties on us. Does, in theory, impose duty on other people and to the state, but the idea is that with human rights, again, we're not concerned about the consequences. Human rights are inalienable, they cannot be removed. They're a universal right. And they're, again, the UDHR, the Universal Declaration of Human Rights, it's kind of an expression of the rights of man and the things that came from the American and French revolutions, sort of 200 odd years ago. Curiously, in Australia, only 3 of the 8 jurisdictions have, well, technically 9, including the Commonwealth, have human rights legislation, with Queensland's being the most recent. And there is what's called a piggyback action. So that if you bring action against a public entity for anything, breach of contract, tort, judicial review, what have you, you can also bring an action for human rights with it and get a declaration. We call that a piggyback action. There is no such thing in regards to income tax law. Why? Because there's no federal statute for human rights, at least not universal statute like the Queensland's Human Rights Act. There are individual statutes like discrimination, age, race, sex discrimination statutes that Australia, they've signed up to a treaty and enshrined in legislation. And so you can still use any of those if they will fit in regards to an action, but you can't use a piggyback action like you can in Queensland. All right, the final branch of normative ethics are called virtue theories. These are quite interesting in that they're actually quite older. They've actually only been relatively recently revived, so to speak, in the 20th century. Thing is with virtue theories is that they are to do with the actor, not the act. All right, ethical behavior is to do with being the correct or ethical person, so to speak. So that's what the virtue theorists have. And look, it's got a little bit more weight than it may seem, but there have been throughout history what we would now call virtue ethics theories. They wouldn't have been called that at the time. And so, for example, Aristotle's the ethical person has traits that encourage human flourishing, that you, as the actor, the right thing for you to do is to have traits that help others live their best lives. The Confucian values, self-cultivation. So an ethical person is one who looks after themselves, follows good role models, builds good relationships with other people, and doesn't follow rules. In fact, always applies their personal judgment and doesn't follow universal rules. Nietzsche, you wouldn't usually think of Nietzsche as being much of an ethicist, but functionally, Nietzsche wrote in the 19th century, 1800s, sort of said that, look, each of us, the right thing for us to do, the moral, the ethical thing, is to not live in bad faith and to live the best life that we can, not through pursuit of trivial pleasure and maximizing utility and things like that. It's to think of our life as a play. Choose the best play that you want and then live it. That's what you should be doing. You should be living your best life. That's Nietzsche's theory. I've included these in here as well. Before I talked about egoism and hedonism as being really bad ethical theories, because they are, and I talked about religious theories being bad as ethical frameworks because they are. Well, this last one, which is an ethical person, is those that has certain traits that are, some of which can be acquired and some of them can't. We, broadly speaking, we can call these desert theories. Now, the idea of desert is that X deserves Y, and me having this certain trait means that I deserve certain things to happen to me. Now, I'll just be blunt about this. There are no good theories of desert. There's people A deserving B because of some certain trait. They don't work. They're not logically consistent. Usually, when you hear people talk about X, somebody deserving something, it's just your own prejudices or their own prejudices just flowing out. So that's, if there's one thing you take away from this, in fact, from anything here, is that no one deserves anything, at least not from first principles. So if you get into an argument about anyone that involves anything to do with moral or philosophy, distributive justice, and people talk about deserve, just your eyes should go glazed, smile sweetly, and just leave it, because you're dealing with somebody who perhaps needs to put a bit more thought into it or read a bit more. Okay, so those are normative theories. Those are the frameworks, the three branches of ethics. So zooming in on this though, that's all fine and good, but how do we do that in the real world? And so the most famous, I guess, ethicist, and I think he's still alive too, he's actually Australian, a guy called Peter Singer, and he wrote a book, and you're gonna laugh at this, Stacey. He wrote that book, I believe he was your age, and that's like the most seminal piece of text in applied ethics. No, sorry, no pressure or anything. And it's still, a lot of it's still valid today, and that's really looking at particular scenarios and situations. Yeah, well, it's harder these days. The baby boomers had it a bit easier. And look, so these have different branches of things. A couple of things to note here is that when we think of legal ethics, medical ethics, business ethics, they have their own particular rules and frameworks in them as well. And often these things are shortcuts. Hey, we've put this rule in place, for example, in legal ethics, and again, I've got them down here, all the various different frameworks, the Australian Solicitors Conduct Rules. Look, they've started with first principles, and we've, over the period of the last 1,000 years of having legal advocates and the common law system, have mapped out some shortcuts so that practitioners don't have to think. Because you're probably aware, when you have a contractual relationship, or in fact as a solicitor, you have a fiduciary relationship with your client. So you can't, for example, make secret profits or breach confidence. This doesn't need to be said, but nonetheless, it is said. So all of these codes of ethics will say, in order to be an accountant, a lawyer, a barrister, a blah, 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 it all says you must act with integrity. It needs to be said again, to be restated as part of that. Now, the key thing to note, there's a whole bunch of these, and because in the particular circumstances of tax practitioners, the thing is with tax practitioners is that often you're actually living between multiple worlds, in that it's not uncommon for tax practitioners to have multiple professional accreditation bodies, so that you may need to report to the accounting society and the QLS and the tax practitioners board. Okay, so you're going to have multiple. Now, the ethical requirements are pretty similar between those things as part of that, but it's just something to note that there are going to be a variety of situations, particularly in terms of reporting, in terms of what you have to do or don't have to do. Now, that's not the problematic one, though. So that's a piece of information. What is of practical concern, though, is conflicts. Now, we as legal practitioners have got really, really firm, strong anti-conflict rules. So conflicts that we have, unless you can have effective information barriers and other bits and pieces, means that you can't act for somebody in a matter, then act for the other side in a matter at a later stage later. Just you can't do that. You've got to go through and not accept those packets of work as part of that. Now, you will find also in your professional life that dilemmas will come up all the time, because ultimately you are, you need to pay your rent, pay your mortgage, and you may have clients put you in uncomfortable situations where you actually literally get told, if you don't do X, Y, and Z, I'm going to drop you as a customer. I'm going to go to your competition, and that can be really hard, particularly if you're reliant on big clients. They have a lot of power over you in that dynamic, and the tax practitioners. It's not at all uncommon for accountants to be told by people, "Oh no, you need to claim this," and you have to go, "No, we're not going to claim that as a deduction. You're not allowed to." And note that the QLS has this. I'm not sure. I presume the Accounting Society has it too. I'm not sure about the TPB, but we have an anonymous hotline. I've called it a few times actually myself, where you can call up the QLS if you have an ethical dilemma and ask them to run through that. Okay, so just make note, when you guys are out in the world, you will have situations where things will be in conflict, and you will need to use your professional judgment, and situations where you can go to third parties to get advice. Okay, now a bit of rules. Registered tax practitioners. Yeah, I do this in much more depth than tax 2. I don't quite know why. There's not really much to it. You have to be 18 to be one of these things. So these are registered tax practitioners, taxation advisors, I think I call them broadly, but they form 3 different types with the loosely. This one being the hardest, this one being the second hardest, and this one being the easiest to go through and do. So TFAs is the harder one, followed by taxation, followed by base agents. Just in terms of the qualifications that you need to go through and do it, there's prescribed qualifications and relevant work experience component. All of them have a work experience component, by the way. There's no getting out of that. And you've got to be fit and proper. Now, Stacey, you do the same thing for law. Basically, it's not technically the same test, but the fit and proper test that you use for becoming hilariously, for becoming a lawyer is a high bar, although I have to laugh at this. It's actually higher to be a JP. So that the fit and proper. So for example, I couldn't be a JP. I'm not making this up. That's a justice of the peace. I didn't pass the fit and proper person, the character test, because, drumroll please, my now ex-girlfriend drove through speed cameras while I wasn't through the country, and I didn't get back and get them signed over within 28 days. I don't know if you're aware that if you are the registered owner of a vehicle and it goes through a stationary camera, you are strictly liable for that. Yeah, it was kind of a tad unkind. So, I was fine to become a solicitor, but I couldn't become a JP until 5 years had passed since the last one. But I think, or maybe it was 1. I think you're allowed 1 in 5 years. But if you get more than 2 in a 4-year period, I think you get disqualified as a JP. I'm a little bit mindful of that. But then I also drive like a grandpa, so that's fine.
Are you technically a practitioner though, in terms of law? Even though you're not practicing?
Well,
that's a weird question, but it's from something else.
There you go.
Oh, okay. All right, I got a question to ask you when this is done then.
Oh, okay. Those ones there. Yeah, I'm entitled to a practicing certificate. Any person, by the way, once you become a solicitor, I'll just tell you this now. By right, you can get a volunteer's practicing certificate, which doesn't cost anything. So mine, I am legally allowed to practice law, but only for an approved pro bono project or through an insured community legal centre. I can't get paid, which is the thing. Oh, actually, I suppose I could get paid. Actually, I think about it, but only by TCL or whoever. There we go. So that's just something to note as part of this. That fit and proper person look at similar, and you would go about it in the same way. So you create affidavits and other bits and pieces. Yes. So that's it. And look, it's the key things they're looking for are honesty things, or rather, sorry, I'll phrase that in the negative. They're looking for dishonesty related things. Don't steal from your employer. Just don't be dishonest. Here's a piece of advice. We're almost done for this session. Piece of advice for anybody watching this. It is it's much easier to live your life just being honest. It takes so much less energy over the long term. And it just, if from time to time you suffer, yeah, sure, you're fessing up to things or to do this, that, and the other thing. But it's just an easier way of living your life. And you don't have to worry about things like this coming up. Yeah, it is. It is a bit. It's just easier. Just it's one of those things. If any of the young guys that are watching this at some stage, just trust me on this one. If you're there at the supermarket thinking you can put that avocado on without swiping it, just don't. Just pay the extra. Don't. It's not only that you get into the habit of being honest, you also get known as being in the habit of being honest too. These things build themselves up over a long period of time, and being a practitioner, and look, I know lawyers, I'm not sure barristers, but certainly solicitors in this city who don't have that. They have a reputation for doing dodgy things, and it sticks. Oh boy, does it stick! Because that reputation you carry that around with you. And if you're going to be a professional, and people are going to be trusting you with things, trusting you with money, trusting you with decisions, you need to have a reputation both for being competent, but also for being ethical as well. So, if in doubt, don't lie about things. I just don't have the energy. The other thing as well, maybe I'm just old. It's just too much drama. So anyway, plus or minus. Okay, there is a code of conduct. Look, this it looks like all of the other things. These things, by the way, the general law imposes these on you as a fiduciary regardless. Confidentiality, not competence. The general law does also impose competence on you, but that's in the area of tort. So these ones are imposed as fiduciary relationships and equity, FD. Competence is in tort. And look, most of the times you're going to have a contract as well. And so that your contract is going to have all of those things. One of them being that you represent that you are a registered tax agent. And if you are a registered tax agent, it means you must follow the code of conduct. That's part and parcel of it. And if you don't, the TPB is the body that takes that, the Tax Practitioners Board, and they can do those things. They can suspend your registration, terminate it. I don't think they can fine you though. I don't think so. I'm not sure. I'd have to check. Unlike the QLS, QLS can actually, well, technically they don't. They can bring the action to the Legal Services Commission. The Legal Services Commission can literally fine practitioners as part of it.